I'm Jack Cumming, and this is the story of my age-related journey. You might call it my journey from insecurity through stress toward security. Not long ago, I was 52 years old and taking stock of my future. A major complication had come into my life. After moving to California for a new job, I was laid off after just 3 years. It seems that New York money interests had bought the company. The New Yorkers thought that the executives were extra. They should be released so that the managers, their understudies, could run the company. The idea was that a good executive trains his successor or her successor, and that those people should be ready to step into the shoes of the senior executives. And since the senior executives are paid more money, you can save money by getting rid of all the senior executives and letting those understudies take over. That could save a bundle of money. Let me reassure you at the outset that all worked out for the best. Still, it was disheartening to leave the company with nothing to look forward to. This is the story of how my wife and I recovered and went on to find meaning for our lives. Perhaps you, too, are facing a similar challenge at midlife. Perhaps you are only fearful that something like that might happen. For us, it was many years ago. Still, the years pass, and the times seem to change, but the challenge of being cast aside before one's time persists from generation and from era to era. There's little difference today from what was the case when I faced this challenge. People are regularly discarded, particularly when there's a new money takeover of the business to which they've devoted their work lives. Faced with uncertain prospects, we summed up what we had toward retirement. After all, here we are, without work. That's not exactly retirement, but we better take stock of where we are. A layoff over age 50 can feel a lot like an unwelcome early retirement. It quickly became certain that we didn't have nearly enough saved. Moreover, there was no way that we could save enough to fund retirement. That gave us pause. Now, I should tell you that I'm an actuary. We tend to be trained to think like planners, make plans, do strategic thinking. And I understand about having savings plans and all of that. But raising children and all of the demands of ordinary family life left us at age 52 without sufficient resources for retirement, for our own future retirement, and there was no way that we had enough years left to be able to follow one of those wonderful plans, even if we had had the discipline and the means and the income to make that possible. We were fortunate, though, in that I soon landed some freelance jobs. I was offered 2 jobs back on the East Coast, but we had already fallen in love with California. I no longer viewed a job as security. Having constructive clients seemed safer, even if initially it was less lucrative. We stayed put, and I did well as a consultant. Now, I should tell you that as soon as I had a sense that we might have to find new work, I started considering whether to go into some kind of freelance activity or to get a job. And so once the reality set in and the axe had fallen, I went out looking for clients at the same time as I was considering job offers. And I was very, very fortunate because within 3 weeks of receiving notice that my job was over and my career with that company had ended, I had 2 very good clients and 2 job offers. But let's stick with the clients because that gave me some assurance that I would be able to build a freelance consulting business. I knew I was too old to start a firm. I wasn't planning to build a firm beginning in my 50s, although now, in retrospect, maybe I might have. But it's one thing to know what you know then, and it's another thing to know what you know later. Finding that consulting work, though, still didn't help us to prepare for retirement. We had age 65 in mind, so we had roughly 10 years to try to make a go of it. There was no clear, easy path to success. My conclusion was that our only choice to get the kind of return that we would need to be able to have a reasonable retirement was to take some investment risk. We thought about that long and hard. We thought first about principles that might guide us. We didn't want to just plunge into investing, nor did we want to just take any risk without considering what might give us greater assurance of success. We realized, though, that we had to do something unique, since following convention, the convention marketed by wealth planners and retirement planning firms and brokerage firms, so following convention would give us results no better than the general market. And that wasn't sufficient. The equity markets reflect a herd mentality. So we thought that some semblance of contrarian thinking was needed for success. So that was our first principle, to think outside the box and think contrary to what everybody else might have been saying, to listen to what they said and to consider it thoughtfully, actively, but critically, to see if there might be another path forward. The principle that we then decided on was to find future-oriented stocks that seemed linked to the changing culture in America. This was early in the 1990s, so the internet had just appeared on the consumer scene in the form of CompuServe and the Sears IBM CBS partnership in Prodigy Online. With Prodigy's flat rate pricing, as I recall now it was $9.95 a month for unlimited internet access over telephone wires. We used to have a modem and dial into a telephone line. With Prodigy's flat rate pricing, it seemed evident to us that the internet would soar as a means toward universal connectivity. We also saw the potential, since Sears was involved with Prodigy and we knew Sears had a big catalog operation, it just made sense that they would integrate online shopping with the catalog operation they had. As it turned out, that didn't happen because the top executives at Sears were more conventional in their thinking, and they shut both those operations down eventually. They shut down Prodigy and they shut down the catalog. But that's beyond our story. We didn't, however, feel that Prodigy was particularly innovative, nor did it seem to have a growth-transcending, idealistic commitment. Perhaps it was that conventional thinking, put profit first, etc., that brought it down. Our idealism led us to our second principle. We decided to invest in companies that were led by executives with high ethical values, beyond mere shareholder value, and who were committed to the common good of humanity. We were very impressed by what we sensed was a close brother partnership between America Online's Steve Case and his brother Dan Case, who was an investment banker. Steve Case was a marketing visionary, with his brother able to keep him within sensible financial parameters. Steve Case envisioned America Online as a path toward global connectivity which might foster people-to-people interactions for the furtherance of world peace. That was the kind of idealistic global vision that we were looking for. That insight hit all our buttons, ding, ding, ding. So we watched America Online stock for a month or so, and we liked what we saw. It had a global vision, a consumer focus, and the upside, international potential, seemed limitless. At that point, we screwed our courage to the sticking point, to quote Shakespeare, and we took what many might consider an unconscionably high-risk plunge. We took half of our total savings and invested in America Online stock. That was a gamble on the integrity of Steve Case's vision of a better world. Prodigy, by then, was already self-destructing due to weak leadership decision-making. Likewise for CompuServe, and America Online was picking up the pieces and prospering. We felt much more comfortable once America Online adopted flat-rate pricing, thus putting consumers first, contrary to the advice of Wall Street short-term thinkers. The stock price took off after that, but that was not obvious at the time. The counseling, the general wisdom on Wall Street was that allowing flat rate pricing would lead to abuse of the structure and that model would become unsustainable for the future. But as it turned out, one of the major inhibitions preventing the growth of the internet was people's fear of that taxi meter running, and they were worried that they might run up a huge bill without being aware of it occurring. So the flat rate pricing made the internet fully budgetable, and as it turned out, it stayed within manageable limits for the most part. From the time we bought into America Online until the merger of the company with Time Warner, our initial investment paid off handsomely. As the stock rose and stock split after stock split followed, we systematically diversified away from America Online. By the time of the Time Warner deal, we were set. The fear that consumed us during those years, when our investments were concentrated primarily in a single enterprise, took from us any taste that we might have had for further adventures. I don't want to underestimate in any way, in fact it's almost impossible to overestimate, the kind of stress that you have when you have that level of your funds invested in a stock and you're watching it go up and down from day to day. Our goal was to have enough money to free us from money worries. We didn't need more than that. Now, you may say, well, that's contrary to all standard investment advice to concentrate that heavily into one security. But consider that every time somebody takes a job, they're concentrating their future, their career chances, they're investing themselves in a single enterprise. So most people in their career thinking don't diversify. We'll come back to that in a minute. So we decided that if we approached investing with the same care that we would bring to considering whether to join the executive team of an enterprise, that we would probably be taking a little more risk than we would have taken had we taken a job. I've known friends who took jobs with seemingly major companies that were going to guarantee their retirement, and ultimately it didn't work out, and they were pretty much in the same kind of quasi-destitute situation that we were. Now, once we had achieved this level that we thought was sufficient so that we could be comfortable, and not wealthy, but just comfortable, we were in for some sorry experiences. Our experiences may spare some others painful setbacks. So I want to share this with you so that you can be thinking about these problems and perhaps avoid the kind of painful lessons that we learned the hard way. First, because we had not enjoyed that stress of following our own investment, we first tried to find a money manager to take over our investing responsibility. A small boutique wealth management firm was recommended to us, and we had several meetings with them to discuss what to do with this large position in American Online stock that we had. We wanted them to average us out of the investment so that we wouldn't take the market shock of selling the stock all at one time. They were unwilling to do that, since their philosophy involved a single portfolio of their choosing into which all of their clients were invested. They insisted that they were going to sell all of our holdings on the day of the cutover, and that, of course, would have exposed us to inordinate market risk, and they were then going to invest that in a portfolio of their choosing. We declined to do business with them, and I can tell you I watched that firm a little bit afterwards, and that turned out to be a wise investment. We would have done much more poorly had we trusted their judgment and their stock picks over just following the general market. About that time, we attended an investors conference which met at the Los Angeles Convention Center. Headlining the event were Charles Schwab the man himself, Jack Bogle, who is the founder of Vanguard. He died just recently, but he was the developer of index investing, and Marie Bartiromo, who was then with CNBC. I think she's moved on since. We sat right up front. We got there early. This huge room, I think there were like 10 or 15,000 people there, but we were right up, I think we were in the second row, so we were right up where we could hear the voices of these men and see them firsthand. Jack Bogle frankly wowed us with his espousal of index investing and the common sense way in which he explained why it was better, because it forces investing discipline. When you rebalance to the index, you're forced to sell high and buy low. Now, everybody knows that the way to do well with investing is to sell high and buy low. But usually people are reluctant to sell their winners, and they hope to get rid of the losers. His reverse, the index, forces you to sell winners and buy what seem to be moderate losers. And that rebalancing seems to outwit the people who try to manage and time the market, because it forces that discipline to sell high and buy low. It was that simple, and it made sense to us. We were also being courted by the private bank division of one of the nation's 3 largest banks. I'm withholding the name since I expect that all banks are equally unscrupulous. We were assigned a portfolio manager and told that our portfolio would be managed individually and conscientiously following instructions that we would provide. So they were going to work with us to develop instructions, and then the portfolio manager would follow those instructions, and our portfolio would receive this individual attention and be separately invested. We directed him to invest in an index of 8 selected stocks. So we made an index, and he was to rebalance the portfolio as the price moved among that narrow index of stocks, and then we were going to meet with him quarterly to rethink the 8 stocks that made up the index. But it seemed simple to keep it to just 8 stocks, since that was about the number of stocks that we could readily get to know and be comfortable with the management and the direction that they were taking. The idea was that the rebalancing, but again, following the index principle, would result in this selling high and buying low. That worked well for a time, but then the portfolio manager left the bank for another job. His successor simply ignored our instructions and sold the entire portfolio and reinvested our holdings in a massive index fund that the bank maintained to track the Standard & Poor's 500 index. Instead of 8 holdings, we now had several hundred. As soon as we learned of this malfeasance, we took steps to move our holdings from the private bank to Charles Schwab and Company, which we had found to be reliable and to have a greater sense of consumer orientation and integrity toward consumers than was the case with the other more sales-driven brokerage operations. The upshot was that our returns from that bank adventure, private bank adventure I might add, it's not the main bank, this is their special facility within the bank for their best customers, our returns were much lower than would they have been if the bank had simply followed instructions. Our loss was considerable. Then, to add insult to injury, the bank charged a transfer fee, a sizable fee for the transfer of each of the hundreds of portfolio positions into which they had invested our money against our wishes. So they charged us we lost money because of their malfeasance, and then they charged us to escape. So we thought then of taking legal action, but we didn't want the stress that would have caused. So we just took the loss and tried to forget about it. The lesson we took away, though, was that banks are large bureaucracies, and it is best not to trust them beyond a minimum. So even though they say, well, we customize and we focus on you as an individual, all that, it's best to stand on your own. Now, I'll affirm that the self-investing module that we've followed with Charles Schwab has not been problematical. It requires a little more effort on our part, but very little more. And Charles Schwab has never departed from instructions in any way. In fact, they've helped us with a number of things which would otherwise have been difficult. So it's unfortunate that the banks don't have that same level of integrity, but I imagine you wouldn't expect that of enterprises that are as large and lumbering as banks tend to become. With those 2 painful lessons behind us, we gradually repositioned our portfolio into indexed ETFs. ETFs are exchange-traded funds. ETFs, exchange-traded funds, essentially are mutual funds, but they're traded throughout the day on major exchanges. And so there are repriced during the day so that you can look at the market and decide when to sell or when to buy. Mutual funds are typically repriced once a day at the end of trading. The result is that there is market risk with mutual funds that exchange-traded funds avoid. With very few single stock exceptions, we've followed an indexed exchange-traded fund portfolio management strategy ever since. When I say with very few single stock exceptions, sometimes there's a stock that we find particularly intriguing. Maybe a friend's involved with the company or something, so we'll buy a small position in it just to be supportive. But in general, our portfolio is run through these indexed exchange-traded funds, and that has worked very well for us. However, even that comes with a caveat, because not all exchange-traded funds are the same. It's important to find exchange-traded funds of good repute and with low expense assessments. The sponsors of the exchange-traded funds have considerable opportunity to glean expense charges from how they structure those funds. The general thinking of the market is that the buyer has to look out for the buyer's own interests. So it's important to compare the expense charges. So it's very important to read the prospectus of the exchange-traded funds very carefully to be sure that you're able to make an expense-to-expense comparison. So you might be comparing 3 funds, all of which seek to follow the Standard & Poor's 500, but you'll find that some have a different expense load than others. And then there are others that, of course, vary slightly. So they might say they cover 100 stocks instead of 5. Whatever. You've got to be very careful in choosing those. But if you choose exchange-traded funds, which are indexed and marketed by the top firms, Vanguard's a very good firm, then you can do very well with that exchange-traded fund indexed investing, in part because you have a lower expense charge. So consider this. If in a current interest rate environment, let's say returns were 3%, well, if a wealth manager charges 1%, your return goes from being 3% down to 2%. Well, there's a very big difference between 3% and 2%. If the wealth manager charges 2% of assets or 1.5%, it can be devastating. So the advantage of the exchange-traded funds is often they only charge, say, 0.2%, and that's a very manageable number, and it spares you the anguish of suffering over whether you're making right choices and doing all the analysis work and the stress, should I buy or should I sell now? That's all off the table, and you can sort of let your portfolio, once it's reached the level that's sufficient for your needs, run on a kind of autopilot. And let me tell you, that is very reassuring. Now we come to the happy ending. Despite these setbacks with trying to offload our investing onto experts, and despite the loss of that job years ago, our investments have flourished and we are now well situated for retirement. Our solution involved a period of high stress and considerable risk, but it worked out for the best. We rationalized our concentration in a single stock as being equivalent to accepting a job with a single employer. We studied the situation as carefully as we would have considered a committed employment situation. Just as a job with a failing company can end badly with unemployment, so investing in a failing situation can end badly. So you wouldn't want to take a job with a company that's not doing well, or if you sense that the company's not doing well, you'd be wise to be out trying to find a more secure situation. The same is true of investing. So you should look at a company you're investing in the same way you would look at a company that you we consider for employment, or maybe that you're employed by, but you're questioning whether your employment is the wisest use of your time and energy. Those thoughts, those concerns, those stresses should be given full weight, and it's wise to act on those intuitions because as often as not, they prove to be well-founded. The reverse is also true. Finding employment with a winner can open opportunities, just as investing in a winner can provide the wherewithal needed for a comfortable retirement. We all know the stories of the people who went to work for Microsoft or Amazon early in their existence and who left employment as millionaires. The same can be true with getting in on the bottom rung of new companies. That's why venture capitalists do so well in helping provide the resources that small startup companies need to prosper. The analogy continues once savings targets have been met. In other words, once you've got enough money, so money is no longer a major concern for your life. Taking a job with a single employer involves the risk that the employer will be hit by an economic downturn. It's not the owners who get laid off when the business shrinks. It's the poor blokes in workaday jobs. Working freelance with multiple clients allows diversification. Instead of losing a job and one's foundational income, losing a client merely means turning more attention toward marketing. You don't have a cliff ending to that income with a severance package and then nothing thereafter. If you have 5 clients and you lose one, you still have 4 clients, and now you've got the time you're spending with the one client to go start marketing, looking for new clients. Thus, for my wife and me, concentration was the key to overcoming the retirement savings deficit with which we were confronted when I lost my job. Once our target was met, though, we were able to diversify our portfolio to avoid concentrated risk. Moreover, the loss of that job was providential, since it proved much more satisfying to work with a variety of clients on my own terms and with a focus on what's right and ethical, rather than having to serve the pretensions of a corporate master. And I guess the wisdom to be drawn from that is if you feel burned out in your job, you feel underappreciated, your path toward advancement is blocked, and people who are less capable than you are being brought into positions senior to you because the senior management is fearful of your abilities, chances are you'll be better off to take your future in your own hands and either start some kind of a business of your own, selling a product or service, or as a freelancer does, selling your own self and your own services out into that market. You know your abilities, you know you have the talent that's not being recognized, and coming in as a consultant is much less threatening to those people in the senior position. They can accept your advice where they might be threatened if you were the direct report. The fear, of course, being the situation that I encountered when the New York people came in and simply said, well, you must have your successors in place, so we're getting rid of all the senior people. The solution to that isn't to have less competent people reporting to you. The solution to that is to have your parachute ready and to have a plan, to always be thinking of an alternative plan where you could function on your own or with a cadre of friends or with a new set of partners to create a new business, perhaps a freelance business, perhaps producing a product. Often people produce a product that their employer rejected because they saw the potential the employer didn't. Think of those Sears people who worked for Prodigy, the online service that was there long before Amazon and America Online. They saw the potential. If they had stuck together when that business was ended and had had the courage and the wisdom to have left Sears to pursue their own vision with their own resources, working as a team, they would have done just fine. And I wouldn't be surprised by what a few of them did. Anyway, that's my journey from insecurity to security. I hope you find your path and that your path is as satisfying and rewarding as mine has been.